Real estate investing can bring big reward and big risks. So know your risks. Welcome to the Real Estate Risk Report, the show for real-world insight on real estate investment risk. Now, here's your host, Lance Pederson.
Thank you for joining the Real Estate Risk Report. I'm your host, as always, Lance Pederson. So today I have with me John Mansour with Titan Funding. He is down in Boca Raton, Florida. How you doing today, John?
I'm doing great, thanks.
Yeah, happy to have you. So the Titan Funding team, they are, my day job is the managing partner of Verivest, and Titan Funding is a recent, a new member to the Verivest Sponsor Network. So we're super excited to have them on board and super excited to have John with us today to discuss private lending and the state of the industry and, what's going on in John's world. So before we get all to that, John, if you wouldn't mind just sort of giving us a bit of a background on yourself and, how you guys sort of decided to, start Titan Funding. I'm always interested in sort of those origin stories and, how people got into the biz and, what keeps them there and those sorts of things.
Sure. And thanks for having me, by the way. So I grew up in a real estate development family in Michigan, mostly commercial development, and worked with my father, uncle, brothers, etc. for many years in junior high and then high school and even into college. And then after college, went to work for what was then Arthur Young and Company, what is now Ernst & Young, in beautiful San Diego for a couple years, where the real estate boom, as it usually is, was alive and well. And after a couple years, went back to Michigan, worked in the family business. As I mentioned, they were primarily commercial real estate developers, and I had the bug for residential real estate development. So I started my own company and developed literally thousands of houses, apartments, condos over the next 20 years or so before semi-retiring, moving down to Florida. Thought I'd relax. And then my business partner, Edward Piazza, dragged me into the lending business, where we operated a net branch of a bank doing commercial and mostly residential loans to the tune of about $50 million a month. And it was at that point, and it was shortly after it was, in 2009, so shortly after the financial crisis. And we saw a massive void in the marketplace and opportunity where commercial loans were concerned. And the commercial banks had pretty much gotten out of the lending business. And we decided to leverage our experience and our contacts. And in 2014, started Titan Funding, doing private loans, in the industry termed hard money loans, bridge loans, etc. And it's been, fortunately, hugely successful. And it's a great platform and a great option for many borrowers, where certainty of execution is critical, and where ease of process, not having to go through all the taking the time and the brain damage, if you will, to work with a commercial bank. So many of our former loan officers are now at those commercial banks, and they consistently feed us bank quality deals that are just, if a square peg isn't in a square hole at a bank, it doesn't get done. So they feed them to us. We get them ready to send back to the bank, and it works out great. It's a very symbiotic relationship.
Yeah, it's been amazing to see that, especially post-crisis, how much banks have receded. I mean, they continue to do so, right? Like it used to be, you thought of a bank, you thought it was sort of part and parcel with one who would lend, right, and borrow money. And now it's really not the case. They're becoming, really lending has just been, of all types, it's just been completely de-emphasized at most banks, and really it's opened the door for, the more private sector, those who more, like you said, the speed and just the ability to get that around, which, I think, the cost of funds might be a little bit more expensive than they were at the bank, but, the speed of execution and those sorts of things has really, I think, helped.
Absolutely. Not to mention, many of our clients, but many of our clients are used to borrowing in an interest rate environment that is closer to what hard money loans are currently. And it's not unusual for us to have clients that come back repeatedly because of the ease of the process and certainty of execution, and the fact that these are true bridge loans where it's a temporary situation. Yeah. At the end of the day, they're only going to be in it for 6 months, 12 months, 18 months, and bridging that gap and getting them to where they can reposition a property, re-tenant a property, and then release a property, get it to stabilize cash flow, and then refinance it. It works out great for them, and obviously it's what we do very well. So,
yeah, no, that's great. So for you guys, like, what's your geographic scope then? Like, so you're located in Florida, but do you lend primarily in the Southeast, or do you lend, so what's sort of your, where are your borrowers located?
Sure. I would say, approximately half our loans are on Florida real estate, and the other half are split amongst about a dozen states. I'm originally from Michigan. My business partner's from New York, so I have a lot of contacts and a lot of ties to the Midwest. So the remaining half of our loans are split amongst Midwest states, Northeast states. We've gone as far west as Texas. We prefer to stay east of the Mississippi, but like I say, Florida is our bread and butter, but we do lend thus far in about a dozen different states. We want to be able to, if we can't visit the properties physically ourselves, we want to have relationships where people can visit those properties, give us property reports, independent third-party property reports, so that we are extremely familiar with the asset that we're lending against.
Yeah, definitely. So in terms of like property types for you guys, then what is it multiple property types, or what, is it single family predominantly, or is there, is it multifamily? How do you guys, what's like kind of that lending box that in terms of property?
Great question. I would say the majority of our transactions, we certainly like the value add residential situation, whether it's a repositioning of a multifamily property, or if it's whether a construction or renovation of high-end single family. But we also do small commercial. We'll do small multi-tenant retail, office, etc. We don't do much industrial, primarily because it's an asset class that neither Edward nor I, my business partner Edward Piazza, neither Edward nor I are. We haven't developed it in the past. We haven't owned it in the past. So we're very comfortable lending on property types, asset classes that we have built, developed over the years. So,
yeah. So for you guys then as underwriters, right? So, there's all sorts of, the good news is like what you just described is a gigantic market, right? So there's tons of, guys and gals out there who are acquiring and those types of assets and executing some kind of value add strategy. But not all sort of borrowers are created equal. So what is your process for when someone shows up and says, hey, John, hey, Edward, I've got this project. I know you get a lot of, obviously, stuff's coming from your referral sources or whatever, but if it's a net new borrower to you guys, you mentioned that you do a lot of repeat business, which of course makes sense. So when people are there, they're going to build a relationship. We can get to that in a minute, but what is the process then for sort of you getting comfortable with, their ability to execute, on any project, right? Like, how do you decide whether or not you even want to issue a loan, LOI or CLA or whatever, you call them?
Sure. It really boils down to four factors. First and foremost, we want to understand and be very comfortable with the value of the real estate, because as I'm sure you've heard many times, with real estate, you make money on the buy side, not the sell side. So we want to make sure that our borrower has enough skin in the game, and the value of the real estate is such that under any market conditions, we and our investors can be made whole no matter what. Next is the integrity of the sponsorship. We certainly believe that how a person has behaved in the past oftentimes is indicative of how they will behave in the future. And we like, obviously, we like repeat borrowers. But for first-time borrowers, we want to understand what they've done in the past and understand their history and how they've operated. Then the next thing is we always want to make sure that we have clean title. And then last but not least is we need to understand the exit strategy, because having a private loan, a hard money loan, a bridge loan is a great tool for many investors, but having that loan for 4 or 5 years is typically not in their best interest. So we want to understand how they're going to transition out of this loan within anywhere from 12 to 24 months.
Yeah, and you kind of mentioned that a lot of times that the deal's coming to you from maybe a more conventional lender source. So is that a lot of the times that then they basically come here, execute the plan, and then they're getting refied out by whoever sent them to you in the first place, or
Precisely.
Yeah.
Yeah, typically once a property obtains stabilized cash flow, once they re-tenant, once they fix it up, once they get it to the point where they can transition out of our bridge loan, we will certainly recommend it and assist them in getting more conventional financing.
Yeah, so there's, I think over the last handful of years, we've certainly seen a lot of private lenders pop up. It's sort of become a thing, right? Like, hey, get into private lending. And you've got a lot of one-off individuals who try their hand at making, what amount to hard money loans or bridge loans to people. So it seems to me that it's a little more difficult than maybe people give it credit for. So maybe you can shed a little light on just, what really goes into it, and how, the ways in which you can really kind of get burned on some of this stuff. You hit on sort of those high level things, but maybe get into some more specifics just about, the little things that you guys do to sort of establish that. Because like you said, obviously it starts with, okay, what's the collateral, and getting comfortable with the value. And my hunch is, and you correct me if I'm wrong, but that's often where many people go wrong, right? So they end up, they somehow, they're an amateur or whatever, they're not as experienced as you guys. You've been in the business since 2014. And obviously you were, got a lot of experience being on the other side of the table. So, but really it's that V and LTV, loan to value, is the key. And if your advance rate is too high on a value that, or to what you think is a 60 LTV or 70 LTV, if the V obviously was much lower, that changes things. So maybe just give some color into like how important that is and the ways that you guys go about establishing what you believe the value is, not necessarily what some random appraiser,
Sure.
or what the borrower thinks it's worth or will be worth, I guess.
Yeah. God bless them. Borrowers always think they're worth more, but which is fine. I've been on that side of the table many times in the past, so I can understand that. But you certainly touched on it. It's understanding what that value is. It's the fact that having been a real estate investor for many years and owned many different types of asset classes, there's nothing like experience that helps in the education process. So we absolutely want to be able to underwrite value, and we don't just rely on what an appraiser says or an independent third-party broker says. We want to trust our gut as well. And I can't tell you how many times we'll receive an appraisal, and I won't accept it, or we'll modify it internally to accept a different value. And if the client wants to move forward, that's great. If they don't, we certainly understand that. But the other thing that, and I mentioned it earlier, which is integrity of sponsorship. You can't put a price on that. Again, what our experience is, the way people have behaved in the past oftentimes is going to be indicative of how they behave in the future. So.
Yeah, I agree. And then how about
we want to make sure that
you guys
we're comfortable with them,
Florida,
we trust them.
It seems that there's quite a immigration,
to do the right thing.
And values are increasing, and so how do you guys handle that dynamic as well? And and just ensuring that, you're comfortable with the collateral and the projects and the cities, and, is that sort of that local knowledge, like how do you guys, handle that? Because that's the beauty of being more local and understanding the markets you're in, right? Is that sometimes one side of the street's different than that, or so just that. And how do you feel about the Florida market and where it's going? It's fun to be, I guess, in a state that's sort of the hot ticket item, and everyone's sort of moving there. But maybe give us a little more color just on the Florida market in general and
Sure.
little nuances.
Your comment is perfect because real estate is a very parochial business. And understanding local markets and sub-markets within a local market is absolutely critical oftentimes. We are fortunate being in Florida because the market here it typically is very good. And even when it isn't good, it is not so good for a relatively short period of time. So, time will oftentimes work itself out with respect to real estate. So at that point, it's holding power. And that's where integrity of sponsorship and understanding how much skin the client has in the game, the borrower has in the game, and understanding what their holding power is absolutely critical. Because at the end of the day, we don't want to own the real estate we lend on. But by the same token, we are not afraid to own the real estate we lend on.
Yeah, and I think that's what's good, and that's where, unlike the banks, they definitely don't want to take that collateral back. They have no, they aren't built for that, and so it's good to say, I'm going to underwrite this loan. I never want to own it, meaning, I don't want to, put yourself in a situation where you're going to have to take it back, but knowing that you could if you had to. And I think that's another one of those sort of differences, right? When you're, if you're a passive investor and you're, there's lots of people you can invest with that are, doing private lending, because of course the source of the capital for most of these deals is coming from high net worth individuals, and most of it at least, or a good portion of it, which we'll get to in a minute. But I just think that's one of the other things to look at as an investor when you are thinking about placing capital with a private lender, that are originating these loans, is just, because once again, let's say worst case scenario, you end up having to take it back, even if it was a trust deed investment, or, obviously it's in a fund, it's a different thing, but ultimately you want to know that the private lender actually would know what to do with it if they got it back. And that's not always the case. And I think that's where, for you guys, and you see a lot of this, right? Like where people, in your position who were active for years, right? Really in the thick of it. It's what ends up making them good lenders, because you've seen everything that can go wrong. You've probably experienced it yourself. And so it's those little things that allow you, when the borrower does walk in, or the project is this, or, whatever, it kind of, you got the spidey sense and the limp and the scars to show it that you've already lived through it. And so it gives you a little bit more insight than if all you've done is sit behind a desk your whole life. No offense to like a banker or someone, but if you've never been out in the field, it is a little bit more challenging to underwrite some of these deals.
No question. Which is also the fact that we've been there and done it gives us credibility with our borrowers, and an appreciation for how the process can and should go. Because again, I've been on the other side of the table. By the same token, years ago when I was on a board member of a bank, and would sit in the loan committee meetings or the executive committee meetings, and would have a loan request, and my comment would be, look, at the end of the day, are we willing to own this property? Because if you're not, then you shouldn't do the loan. Not that you want to own the property, but you have to be prepared.
Yeah, you got to be prepared, and that's what we saw was with a lot of the banks. It just crushed them because the special assets departments and all that, it just weren't equipped, and then they just can't recover. Now that ended up benefiting a bunch of the guys who came out of it, and then hence the private lenders who then borrowed them. The guys that end up acquiring the assets under the distressed assets to really make some hay the last 10 years or so. So yeah, I mean, let's cut to the other thing, like how investors get involved, because like this is sort of talking about, you know, how originators like yourself sort of position yourselves and how you guys, you know, sort of decide, you know, whether or not to fund a loan and the thresholds and those things. And, you know, in a shocking development goes back to, like you said, it's like the money's made in the buy, so better make sure you understand what the value is, understand who's involved. You know, those are the recurring themes that we hear on the show. But how investors can get involved, you know, is with a private lender, you know, there's a couple different ways, right? You could, you know, some lenders offer the ability to sort of fractionalize a loan, right? So if there's $500,000 loan that's going out, you know, you can have many investors who own a piece of that, you know, mortgage or trust deed, and, you know, and then typically the originator will be the servicer and take some sort of servicing fee, you know, off the top before passing the net proceeds on. You know, some can just do, you know, take the whole loan themselves, right, rather than having it be fractionalized. And then you have more of the fund model where the investor invests either, you know, typically equity into a partnership or borrows money to a partnership in the form of some sort of note itself. But ultimately that partnership is the one that purchases the loan that the originator has originated and holds it, and so there's more of a pooled format. So once again, underwriting those things are it's a different animal, right? I mean, one is you get to pick and choose the loans that you would allocate capital to, but once again, in all cases, if you don't have the skills yourself to work that thing out, should it go sideways, nor if the originator who's servicing the loan doesn't have the skills, you know, it could be a bit of a mess, and hence certainly much more risk. So I think that at the heart of it is, who's the originator and who's the servicer is important. You know, who's going to take care of the things, because they don't always work out. Not every project, you know, goes as planned. But then you have, you know, investing in a pooled investment vehicle as a member or partner with other partners. So how do you guys handle that? And I believe you've sort of done a hybrid or a mix of those, but maybe you can kind of speak to how, you know, you view that in the capitalization of these, you know, opportunities in the form of bridge loans.
And, you know, as an investor, when everything's going right, everything's beautiful, it's all rosy, it's very easy. But, you know, you raised the point, and it's it's such a good point. It's when everything goes sideways that you want to understand who you're doing business with. So as an investor, and we've operated the fractionalized model, and it's worked out great for our investors, where we have 1, 2, 3, 4 investors take a piece of a loan, where we originate it, we service it, they get paid, etc. And we've transitioned, we've decided to pivot and do a fund, and that's what our business model is going forward, and that allows for pooling of all the loans, thereby mitigating risk. But the other thing it allows for is we add a leverage component. So at the end of the day, you know, our targeted return for our investors is close to 15%, and we can do so without increasing any risk, which is pretty remarkable. But again, it all boils down to who's underwriting the loan and then who's servicing the loan. And you know, we have a tremendous amount of experience doing both, and fortunately, it's worked out real well for both ourselves as well as our investors.
Yeah, and I think that is important when you're looking at, you know, whether or not you're going into in a fractionalized position on a single loan or buying a whole loan from an originator. You know, I think that the important thing to understand or to ask, right, is to get sort of those war stories, because it's not a matter of if, it's a matter of when. Loans do go sideways. It's so, you know, don't let anyone tell you any different. I mean, I'm sure there's little runs that people can go on where, you know, they really have no sort of defaults or delinquencies or whatever. But, you know, if you've been around long enough, it happens. And so, you know, I think it is important to ask those questions, right? It's just like, tell me, you know, the loan you wish you could take back, right? Like, and if they don't have an answer, like, well, I've never had one, that, you know, like, that doesn't exist. To me, that's more of a bad sign than a good sign. So I mean, with that said, like for you guys, what's the one that you wish you could take back? Like, man, that one looked great, but it just, it just didn't turn out the way we wanted to.
And I have to agree. If you've never had any delinquencies or defaults, then you just haven't done enough transactions. That much I guarantee.
Yeah.
But I would say, we literally in the almost in the 7 years we've been doing this, we've not had a single instance in which our investors have not been made whole. There have been instances, very few fortunately, where they haven't gotten the full amount of interest that we had hoped for or they had hoped for, but in all cases they've received the full principal back. I would say in terms of any deals, some that would have had more hair than others and maybe we wish we hadn't done, I would say we had a transaction in Kentucky that we went and visited the property. It was a commercial property. We did the loan, but at the end of the day, it was a little more rural than we fully appreciated at the time, and it took longer to work out. But at the end of the day, our investor was made whole. He got almost all the interest that he expected. It just took longer than anticipated.
Yeah, it's neat that that's sort of how your experience. I mean, our experience as lenders would sort of echo that. It's the depth of a given market, right? Like what I would call liquidity, right, really makes a difference. Once again, everything's going well. Of course, it's great. Like it's just things work out. But what does happen is that when the more tertiary and the further you move out, into rural areas or whatever, it's just as lenders, it's really something to be conscious of, because if something does that you didn't foresee happens, it's just that thing's not gonna, that exit strategy that you underwrite for, the number of exits and the ways to get out of it are diminished, because a lot of times you talk about exits, just conventional financing, whatever, but it really means, yeah, but what if, what if we do take it back? Do we want to own it? And then how in the heck are we going to get rid of it? Who's going to buy it? Who's going to want it? And that becomes the issue. And then those things often, they just serve as sort of dead capital. Now, this is a bit too where I think that, the benefits of a fund, right? I mean, that's just is like picking and choosing loans. I mean, sure, if it's just right down the pipe, then, you go into one loan, but you concentrate, whatever it is, a couple $100,000 or, up to $500,000, whatever it is, in one loan. I mean, that's sort of like walking in and, at the casino and just like, putting all your money on, 11 or something like, black and 11 black, like, okay, you're done. Like if it hits, great, but if you don't, that's sort of bad. Not that dramatic, obviously, but I think that in a pooled vehicle, right, just having exposure, especially because when you look at what this instrument is providing to a passive investor, is really an income play, right? So it's more about this. You're getting steady income because the borrower has interest accruing, and so it's solving the problem in your portfolio because your portfolio needs income, and this sort of fits it. Well, being in a fund that has many loans, right? It's, once again, they're not always going to all work out in terms of just hey, they'll probably get all the principal back. I mean, that's what you can hope for, but some of them do stop paying, and some of them you have to work out or whatever. But when you look at it as a pool of loans, you sort of just you now have the diversification, and you still get the problem you're trying to solve, which was income. So I think that's because and I'm not sure if you guys have experienced it. My guess is, because I've talked with many lenders, it's like making the transition from providing people access to fractionalized loans to a pooled vehicle seems to be hard for those who got hooked on the fractionalized piece of it, right? But I would argue that, I guess my take is, and hence why we're, trying to help educate people and get them up to speed, is just that, they think that, once again, if you can do business with people who are good originators, have good deal flow, who know how to work out deals, they can learn how to manage a fund or whatever, but ultimately that is a better risk-adjusted product more often than not to the investors, having access to a pool of loans rather than you deciding to picking and choosing which loans you go into.
No, you're
Just from a pure, straight risk perspective, I would say it's riskier, and you have more that concentration risk is, and I'm not sure. Once again, your compensation isn't. It's probably about the same, or less, which is a segue, I guess, into, you mentioned that at the pooled fund level, right? So if everyone invests equity into the fund, and then it originates loans that have the borrowers have skin in the game to the tune of what, 20%? What do you guys require?
for the borrowers.
For the borrower, how much do they have to have in?
Typically they have 40-50% equity in the deal.
There you go. So like, just to, in their case, right? Like, so then you've got, you're borrowing them, but then in terms of loss, that, the borrower is going to feel the pain first, up to 40-50%, right? And now, the fund, if you burn through that equity, now the fund's going to feel it. But once again, it's just going to be a fraction of the whole, rather than you feeling the brunt of the full loss as the investor in a single deal. But you mentioned that in your case, that sounds like the fund is borrowing some of the money. So in this case, the members are in sort of second position. Ostensibly. So the borrowers could lose his, and then the next equity loss would happen to the members of the fund, and then the banks, and in the liquidation priority, the bank's going to get paid proceeds first, or whoever is serving as the bank. So maybe share a little bit about how you guys decided, why you decided to do that, what that sort of the leverage at the fund level looks like.
Sure, and I have to say we haven't encountered anybody that's participated in our fractionalized loan model that hasn't indicated that they would like to make the conversion to the fund model.
Good, you got smarter investors than others, so that's
well.
great.
Fortunately, we are very good.
You guys are very persuasive.
But part of it is, and this is where I have to give credit to my business partner Edward Piazza, extremely tech savvy, and we have a tremendous back office team, as well as underwriters, fund managers, etc., that allows us to make monthly preference payments to our investors, and then quarterly profit distributions. So at the end of the day, we're paying a 7.5% annualized pref with a targeted yield of 15% annualized, and that gets paid on a quarterly basis. And as fund managers, all the money that we generate goes into the fund as part of the revenue, part of the income, before it gets divvied up. So we're highly motivated to make sure that we make the right decisions, and we're right alongside our investors there. But as it relates to the benefit of not just pooling loans and mitigating risk, but adding leverage, we're borrowing money at sub 5%, loaning it out at 11 or 12%, and making that arbitrage, which is a fantastic enhancement for our investors as well as ourselves. So, and anytime you have sophisticated investors, which fortunately we do, they understand that benefit.
Yeah, and so in this case, so you're taking all the origination fees that you're earning on the origination of the loan and putting them in as the fund is collecting that as income. Is that what
That's
you're
correct.
saying? Yeah. So that's really good alignment, because that's the other thing to look out for, is that when someone's using a fund model, so they're the ones who are obviously you've abdicating your decision making to the fund manager, who also is the one who was the originator, who decided whether to do the loan or not, and if they're earning a fee, usually 2-3%, what it depends, right? But it's not zero. And if they get the full force of that origination fee up front using the money of the fund, they're sort of incentivized to just originate loans. And once again, there's no such thing as sort of perfect alignment in these sorts of vehicles, but certainly, finding a fund that has, where the originator is putting all the fees into the fund, and then it has to run through the waterfall, first, is good alignment. And then in terms of like the leverage component, what are the, how does that look from your guys' perspective in terms of, so it's the cost of capital is 5%, what is the advance rate that you guys are comfortable, how much of that, can you, and how much are you guys comfortable, drawing off of that? So if you fund a loan for 500 grand, how much of it, that 500,000 is coming from this, credit facility or, lender, and how much of it is just, member equity?
Yeah. And unfortunately, the borrowing rate is sub 5%, but it's, of course, subject to increase. But and typically, it's a 1-to-1 ratio. So if the loan is $500,000, we have $500,000. We have $250,000 in member equity, $250,000 in the warehouse line of credit.
Yeah, and that's where you get that, like you said, you get that lift then, because if you got all the points and then you've got the interest on the loans, and then the fact that you have to pay, and half of the capital that's been deployed, you're paying 5%, and then the rest is what gets you sort of into that double digit, mid-teen potential sort of annualized return at the fund level. Yeah, and certainly from the standpoint of risk, there's more risk. Obviously, the presence of leverage at the fund level creates more risk than the absence of it, right? But I think it is important to understand that most leverage, even if you're, multifamily leverage enhances yield. That's mainly what its job, typically is. When you're borrowing money, you're trying to juice the return, and yes, borrowing money, creates more risk than not borrowing money, mainly because you've got some other party who's saying, well, I'm first in line and you're second. And that's where it just becomes important to understand what the collateral is, and knowing that you've got room at the loan level, right? That someone's, those borrowers are going to feel the pain first, and, that sort of thing. But, and then if the lender just, it all comes, the devil's in the details, right? In terms of
precisely correct.
Yeah, that's, I think it's not all created equal, but those are things that are important as passive investors, is to just, because I meet some guys, passive investors, and I get it, and they're sort of like leverage is the devil sort of people, and I'm, I understand what they mean, but it's sort of like painting it with a very broad brushstroke, right? Like just saying leverage is evil. Maybe if you have some religious sort of reason why you don't like leverage, whatever. Once again, to each his own. But I just think that, to me in this business and investing in general, is that it context is very important, and the answer to most questions is it depends, because of the context. You really need to dig in and understand these things, right? And understand all of these different pieces and get comfortable with them, and understand that it's not a matter of risk exists. Okay, it just does. There's risk everywhere, and when it comes to investing in financial, there's sort of the closest thing we got is a T-bill or whatever that's risk free, but even that is not. It's technically true, it's guaranteed, but it really comes down to who's the guarantor. Well, the United States government. Well, today it's really good, but I don't know, in 50 years maybe that changes. I have no idea. None of us do, right? And so understanding who all these parties are that are involved, who's underwriting the loan, who originated the loan, who funded the loan, who's the borrower, where are they at, where's the collateral at, right? Like, you have to really look at all those things. What am I investing into? What are the terms, and all of these things. If there's a credit facility, what does that agreement say, right? And what is the recourse, and all those kinds of things, because every little thing could change there, and it could change the complete nature of the investment if you don't understand it. So it's like, know what you're getting into. It's great. We all want 15% returns. Of course we do, right? And but not all 15% returns are created equal. I think that's mainly what I'm getting at.
They are not, and fortunately, I think we found a way to provide that investor yield and still mitigate risk tremendously, which is a pretty rare combination.
Yeah, it's the high and dry effect, right? Like it really comes down to, 80% advance rate, would be scary, right? 50% advance rate, it comes down to how aggressive. Once again, it's all matters like how aggressive are you on the on the lending, right? I've met lenders that are basically doing 100% loan to cost, right? So as far as the borrower has nothing in it, right? So their incentive and motivation is not as high as it would be if they had 30-40%.
Exactly.
If they had their own money in. It's so the skin in the game and all that kind of stuff is where it does make a difference, because if the project goes sideways and they just say, I'm out of here, I've got nothing to lose. The reason I just keep harping on this is that because there are lots of private lenders. Lots of people think they can do it. And it's just they're not all created equal, and not every structure is the same, and all that stuff. And you need to, if you want to get in the game and you want the benefit, you got to understand how to underwrite it yourself.
You know what, Lance? It's all about discipline, and I've seen it all too often. It's the old saying, "It's not my first rodeo," and a lot of guys all they want to do is lend, and it doesn't work that way. You need to understand the collateral. Bottom line, that's why it's always first and foremost in every deal is understand the collateral, and then the second item again is integrity of sponsorship. So.
Yeah, it's the counterparty. It's like who you working with, and that's where and of course that's what my passion is. That's what we do. Like I said, my day job, Verivest. That's the whole thing. It's all about the people, who you dealing with, and who are they, and knowing who they are, and knowing what they've done, and the representations they make. Are they accurate? It's the same thing that you do downstream when you're looking at a borrower. It's just those are the things that you have to get comfortable with, and it's not and I feel like that for me that has been sort of the thing, is that a lot of people say, well, it's too hard to do it. So then what? That means that you just blindly invest into random things, because it was too hard and you couldn't figure out how to do it. That was kind of where we were at, but for me, I'm like, okay, well, what if we did it? What if we ran the background checks? What if we verified the track? What if we monitored what was going on? We know how to do those things. And for me, that's what allows more people to participate, because at the end of the day, like I said, we've all got an investment portfolio, and that a portfolio has a job. It has multiple jobs, one of which is generating income. It should have some growth component, right? It needs to be diversified, and depending upon where you're at, those are things that you have to decide on your own. But giving more access to these things is good for everybody, and I think that that's what you've been a part of over the years, and I've seen it. And it's exciting to see more people that are able to participate in these things, because it can change lives. It can change how much you have to retire with, and the next generation, and you're seeing some of those things being redistributed from those. I know it doesn't feel that way at times to people, but I do think that that's what's upon us here, is that, and I don't want to go as far as like democratizing, alternative investments, or I don't necessarily think of it that way. I think that's what's happening. Right, but just getting to see that people can get access to opportunities like this that are based on, as we've discussed and spent this time doing, sound business principles. And it's things that need to be done that benefit communities, and all of those things. And it's whereas like we started with, is that historically the banks kind of controlled all this stuff, and I'm not like a huge fan of banks, but I'm not, a hater of banks either. They have a place. It is what it is. I can't change that. But just seeing some of these things be unbundled, so to speak, and allow others to participate in entry points and access points for what I'd call more ordinary people is also pretty cool.
It's interesting because as you mentioned banks, and banks have figured out how to make a tremendous amount of money without taking much risk. And the risk they do take is at such a high level that when things do go sideways, it's a huge problem. But in the type of loans that we do, they, for all practical purposes, have gotten out of the business, which has created a massive opportunity. By the same token, we need to stick to our knitting and understand fundamentally what we do well, and make sure that we continue doing that, because it's a problem when you don't stick with your fundamentals. My father said many times when I was growing up, your reputation is something you build over a lifetime and can lose in 5 minutes, and govern yourselves accordingly. So,
yep. Yep.
Pretty easy when you think of it in those terms.
Yeah, it is, and that's wisdom, and I think that's exactly how it goes. And I think that living your life with that sort of as your guiding principle, right? Of just knowing that it's going to be hard, you're going to have to earn it, but you can lose it all really, really fast. Yeah, good stuff. This is a great conversation. So, as I mentioned, Titan Funding's maybe I didn't, but Titan Funding's one of the new sponsors in the Verivest Sponsor Network. So you can find them on verivest.com. But where else can they learn more about what you're up to, John, and Titan Funding?
Sure, just go to titanfunding.com. Very easy.
There you go. God bless the internet. So titanfunding.com. Well, thank you so much for your time. Appreciate it, and we'll be in touch.
Sounds good. Thanks, Lance.